Pwidrasa. September 23, 1998. A Wednesday morning in Lower Manhattan. 16 of the most powerful people in American finance are sitting in a fourth-floor conference room at the Federal Reserve Bank of New York. The heads of Goldman Sachs, Merrill Lynch, J.P. Morgan, and every other major Wall Street firm. They've been summoned here with less than 24 hours' notice. They're not here to discuss interest rates or regulatory policy. They're here because a single hedge fund, one that 4 months earlier seemed utterly invincible, is about to detonate the entire global financial system, and they have roughly 72 hours to prevent it. The fund's name was Long-Term Capital Management. Its leaders included 2 Nobel Prize winners in economics. Its strategy was built on mathematical models so sophisticated that most professional investors couldn't understand them. Its returns for years had been so consistent, they seemed to defy the laws of finance itself. And in the span of 4 months, it had lost $4.6 billion, more money than most countries' annual GDP. Worse still, its positions were so large, so interconnected, and so leveraged that its collapse threatened to trigger a cascade of margin calls and forced liquidations that could freeze credit markets worldwide. This is the story of how the smartest people in finance built a machine designed to eliminate risk, and instead created one of the most dangerous entities in modern financial history. Long-term capital management didn't start as a reckless gamble. It started as the opposite, a scientific approach to extracting profit from market inefficiencies with minimal risk. The architect was John Meriwether. Throughout the 1980s and early 1990s, Meriwether had run the bond arbitrage group at Salomon Brothers, one of Wall Street's most prestigious firms. His team became legendary, not just for their profits, but for their intellectual firepower. They didn't rely on gut instinct or market rumors. They used quantitative analysis, complex mathematical models to identify tiny pricing discrepancies between similar securities. Meriwether left Salomon Brothers in 1991, following a treasury bond scandal he wasn't directly involved in, but which swept through the firm's leadership. By 1993, he was ready for his next move. But this time, he wasn't joining another firm. He was building his own. The pitch was elegant. Markets aren't perfectly efficient. Securities that should be priced identically, say, 2 different government bonds with nearly identical maturity dates and risk profiles, sometimes trade at slightly different prices. These gaps rarely last long. When they appear, sophisticated traders can buy the cheaper one, sell the more expensive one, and capture the difference when prices converge. The profits from each trade are tiny, often fractions of a percent. But with enough capital and enough leverage, those fractions add up. And if your mathematical models are good enough to identify these opportunities consistently, with minimal risk of loss, you can generate steady returns regardless of whether the broader market goes up or down. To execute this vision, Meriwether assembled what may have been the most intellectually impressive team ever gathered in finance. In 1994, he brought in Myron Scholes, one of the creators of the Black-Scholes model, the formula that revolutionized options pricing and became the foundation of modern derivatives trading. 2 years later, Scholes would win the Nobel Prize in economics for this work. He also recruited Robert Merton, another giant of financial economics, whose work on portfolio theory and derivatives pricing would earn him the Nobel Prize alongside Scholes in 1997. David Mullins, the former vice chairman of the Federal Reserve, joined as a principal. So did Eric Rosenfeld, a Harvard Business School professor and former Salomon colleague. The roster read like a who's who of quantitative finance. Investors took notice immediately. LTCM launched in February 1994 with $1.25 billion in capital, an enormous sum for a hedge fund at the time. But there was a catch. Meriwether and his partners imposed strict terms. Investors had to commit their money for at least 3 years. The fund charged a 2% annual management fee, plus 25% of profits, higher than the industry standard. and the partners offered almost no transparency about their specific trades or positions. The message was clear. If you want access to the Nobel laureates and the mathematical geniuses, you play by our rules. And for the first few years, it worked spectacularly. Between 1994 and early 1998, long-term capital management delivered returns that seemed almost mechanically consistent. In 1995, the fund returned 43% after fees. In 1996, 41%. These weren't just good numbers, they were exceptional, especially considering the fund's strategy was supposedly low-risk arbitrage, not high-flying tech speculation. The secret wasn't just the models, it was leverage. LTCM's trades captured tiny price differences, often less than 1% of the position's value. To make meaningful profits from such small margins, the fund borrowed vast sums of money, amplifying its positions. By early 1998, LTCM had equity capital of roughly $4.8 billion, but its total balance sheet had swelled to over $125 billion, a leverage ratio of about 25-1. For every dollar of the partners' and investors' money, the fund had borrowed 25 more. And that wasn't the full picture. LTCM also held enormous positions in derivatives, contracts whose value derived from underlying assets like interest rates, stock indices, or currency pairs. These positions, measured in notional terms, exceeded $1 trillion. The firm's risk management models insisted this was safe. The positions were hedged. Each trade was designed so that losses on one side would be offset by gains on the other. The computer models, back-tested on years of historical data, showed that catastrophic simultaneous losses across multiple positions were statistically improbable, so rare that they could be safely ignored. Wall Street's biggest banks agreed. They lined up to lend to LTCM, offering exceptionally favorable terms. The fund's reputation was impeccable. Its leaders were Nobel laureates, former Fed officials, and proven traders. What could go wrong? In late 1997, Meriwether and his partners made a striking decision. They returned $2.7 billion in capital to investors. The fund's own money was generating returns so strong that outside capital was becoming a drag. They'd have to share the profits. Better, the partners concluded, to run a smaller, more concentrated fund and keep more of the gains for themselves. It was a decision drenched in confidence, and it came just months before everything unraveled. The trouble began halfway around the world, in a place LTCM's models had largely dismissed as irrelevant. In the mid-1990s, Russia was transitioning, chaotically, from a command economy to a market economy. The government issued bonds to finance its operations. Yields on Russian debt were high, reflecting the country's instability and default risk. But many investors believed Russia was too important, too large, and too politically connected to the West to be allowed to fail. LTCM held positions in Russian bonds and related derivatives. Not enormous positions by the fund standards, but significant. In August 1998, Russia's financial crisis reached a breaking point. The government, facing plunging tax revenues and a collapsing currency, did the unthinkable. It defaulted on its domestic debt and devalued the ruble. The immediate effect on LTCM was painful but not fatal. The fund's Russian positions lost value, but they represented a small fraction of its portfolio. The secondary effect was catastrophic. The Russian default triggered a global flight to quality. Investors around the world, spooked by the idea that a major sovereign borrower could simply refuse to pay, began pulling money out of anything remotely risky and piling into the safest assets they could find: U.S. Treasury bonds. This was the opposite of what LTCM's models predicted. The fund's core strategy, arbitrage between similar securities, relied on the assumption that prices would converge over time, that if two bonds were fundamentally similar, any temporary pricing gap would close as rational investors spotted the opportunity. But in August 1998, prices weren't converging, they were diverging. The spread between safe assets and riskier ones, even slightly riskier ones, was widening dramatically. Treasury bonds soared in value. Corporate bonds, mortgage-backed securities, and emerging market debt plummeted. LTCM was on the wrong side of nearly every one of these moves. The fund had bet that spreads would narrow. Instead, they exploded. And because LTCM was leveraged 25-1, small losses on individual positions compounded into existential losses on the portfolio as a whole. In the first 3 weeks of August 1998, LTCM lost $1.9 billion, nearly 40% of its remaining capital. By late August, the partners faced a grim reality. The fund's losses had been so severe that its lenders, the same Wall Street banks that had eagerly courted LTCM months earlier, were now demanding more collateral. This is the mechanics of leverage. When you borrow money to invest, your lender requires you to post collateral to secure the loan. If your positions lose value, the collateral's value drops. When that happens, the lender issues a margin call. Post more collateral, or we liquidate your positions. LTCM faced enormous margin calls. To meet them, the fund had two options: inject fresh capital or sell assets. Fresh capital was hard to come by. Meriwether reached out to legendary investor Warren Buffett, to major banks, to wealthy individuals. The conversations went nowhere. No one wanted to invest in a fund hemorrhaging money with no clear path to recovery. That left asset sales. But here, LTCM hit a paradox. The fund's positions were enormous, so large that selling them in the open market would depress prices further, guaranteeing bigger losses. And the market already knew LTCM was in trouble. Other hedge funds and trading desks, smelling blood, began betting against the same positions LTCM held, driving prices even further in the wrong direction. The losses accelerated. By mid-September, LTCM's capital had fallen from $4.8 billion at the start of the year to barely $600 million. The fund's leverage ratio had skyrocketed to over 200-1, and the banks holding LTCM's loans began to panic. If LTCM defaulted, those banks would seize the fund's collateral and try to sell it. But with positions so large and so interconnected, forced liquidation could trigger chaos. Other firms holding similar positions would see their values collapse. Margin calls would spread like contagion. Credit markets could seize up entirely. This was the nightmare scenario regulators had quietly feared, but never seen on this scale. A single entity so large, so leveraged, and so enmeshed in the financial system that its failure could threaten everyone else. The Federal Reserve was watching closely, and in late September, it decided to intervene, not with a government bailout, but by orchestrating a private one. On September 23, 1998, representatives from 14 Wall Street firms gathered at the Federal Reserve Bank of New York. They were not there voluntarily. The Fed's president, William McDonough, had made clear that attendance was expected. The implicit message: if you're one of LTCM's major creditors and you let this fund collapse, you'll bear some of the responsibility for what happens next. The Fed did not offer taxpayer money. It did not guarantee LTCM's debts. What it did was facilitate a private sector solution, a consortium bailout. After intense negotiations, the banks agreed to inject $3.25 billion in fresh capital into LTCM in exchange for 90% ownership of the fund. The original partners, including Meriwether, Scholes, and Merton, would retain a small stake and remain involved in unwinding the positions. But their control was gone. It wasn't a rescue out of charity. The banks calculated that this was the least bad option. Letting LTCM fail could trigger losses far exceeding the cost of the bailout. Over the following months, the consortium carefully unwound LTCM's positions. Markets had stabilized somewhat after the acute panic of August and September. Spreads that had blown out began, slowly, to converge again, exactly as LTCM's models had originally predicted they would. The irony was bitter. The fund's fundamental thesis had been correct. The prices did eventually return to rational levels. But timing, as the old saying goes, is everything. LTCM's leverage left it no room to survive the irrational period in between. By early 2000, the consortium had liquidated nearly all of LTCM's positions. Some of the bailout investors even made a modest profit. but the original partners and investors lost billions. The fund was formally dissolved. In the aftermath, investigators, regulators, and financial historians asked the obvious question: how did the smartest people in finance, including 2 Nobel laureates, get it so wrong? The answer lies in the difference between risk and uncertainty. LTCM's models were extraordinarily sophisticated at measuring known risks, the probability distributions of asset price movements based on historical data. They could calculate, with impressive precision, the likelihood of a 2% daily loss, or a 5% weekly loss, or a 10% monthly loss. What they couldn't account for was the unknown, the sudden correlated breakdown in liquidity across multiple markets simultaneously, driven not by fundamental economic changes, but by panic and the herd behavior of investors fleeing to safety. This is sometimes called tail risk, the extreme low probability events in the far ends of the probability distribution. LTCM's models acknowledged these events existed, but treated them as so rare they could be ignored for practical purposes. August and September 1998 proved that assumption wrong. Tail events, however improbable, do happen. And when you're leveraged 25 to 1, you cannot survive them. There was another factor: LTCM's own size. By 1998, the fund had grown so large that it had become a significant player in the very markets it was trading. Its positions were known, at least in outline, to other sophisticated market participants. When the fund's distress became public, competitors didn't step in to stabilize prices. They piled on, accelerating the losses. The models assumed markets were deep and liquid enough to absorb LTCM's trades without moving prices. That assumption held during calm times. During a crisis, it collapsed. Long-term capital management's collapse sent shockwaves through finance, but not lasting ones. In the immediate aftermath, regulators and banks pledged to scrutinize leverage more carefully, to demand greater transparency from hedge funds, and to monitor systemic risk more aggressively. Some reforms were implemented. Banks tightened their lending standards for a while. Regulators began paying closer attention to hedge funds' interconnections with the broader financial system. But within a few years, many of the lessons seemed forgotten. Leverage crept back up. Complex derivatives proliferated. Models grew more sophisticated, and with them, the temptation to believe that risk had been engineered away. A decade later, in 2008, the global financial system experienced another crisis, this time centered on mortgage-backed securities and the interconnected leverage of major banks. The mechanisms were different, but the underlying dynamic was hauntingly similar. Sophisticated institutions, using complex models and high leverage, convinced they had mastered risk, brought to the edge of collapse by events their models said were impossible. John Meriwether went on to launch another hedge fund. Several of LTCM's former partners returned to successful careers in finance. Myron Scholes and Robert Merton remain celebrated figures in economics. Their Nobel Prize-winning work is still taught in every serious finance curriculum. No one disputes the intellectual brilliance of their models. What remains disputed is the leap from "this model is a useful approximation of reality" to "this model can be trusted absolutely, even under extreme conditions." So what is long-term capital management's legacy? For some, it's a cautionary tale about hubris, proof that even the smartest people, armed with the most advanced tools, can fall victim to overconfidence and misjudge risk. For others, it's evidence that financial markets are fundamentally unstable, prone to panics and crises that no model can predict or prevent. And for regulators, it remains a case study in systemic risk. The danger posed not by any single institution's recklessness, but by the interconnectedness of the system itself, where the failure of one player can cascade into a threat to all. What's undeniable is this: LTCM was not brought down by fraud or stupidity or bad intentions. It was brought down by a combination of extreme leverage, model limitations, and the cruel timing of a market environment its architects believed was statistically negligible. The fund's partners were not charlatans. They were pioneers who genuinely believed they had discovered a better way to manage risk. They built a machine designed to harvest small, consistent profits with minimal downside. But they forgot or underestimated a truth that dates back centuries in financial markets. You cannot eliminate risk. You can only transform it and sometimes defer it. And when it arrives, concentrated, unexpected, and merciless, no amount of genius will save you if you bet the house on the assumption that it wouldn't. September 1998 was the moment that lesson was relearned, at a cost of nearly $5 billion and a close brush with global financial catastrophe. The smartest people in the room built a machine they believed couldn't fail. They were wrong, and for a few harrowing weeks, the world held its breath while Wall Street's most powerful institutions scrambled to contain the fallout. The machine was dismantled. The crisis passed, but the questions it raised about leverage, models, risk, and the limits of human knowledge remain as urgent today as they were 25 years ago.